Good morning, ladies and gentlemen. Welcome back to Boutiques on Wednesdays. Seems like winter is back on most parts of the country. It's the 2nd of October. Go figure. Markets gave up some of the previous week's gains as the Fed signals a slow approach in rate cuts. And then recent attacks on Israel from Iran are raising fears of a war wider spread across the Middle East and increasing geopolitical tensions globally. That may very well have an impact on an already tight US electoral race. It seems like nobody knows what the outcome can be. On the other side of the world, Chinese stocks surged on the back of last week's most aggressive stimulus measures. Yet some reckon this may not be enough to fix their economy. But what about Europe? Is this perhaps an attractive value play to access the US and a low-risk way to access emerging markets? And what are some of the lessons learned in managing global equities from South Africa? Fantastic here to unpack this morning, global views and global equity. It is my absolute pleasure to welcome Head of Global Equities at Vunani Fund Managers, Rory Spannenberg, and Portfolio Manager Andreas Jan van der Horst at Mazi Asset Management. Good morning, Rory. Good morning, Andreas. How are you doing this morning?
Good morning. Thank you very much. Doing just fine.
Good morning, Eugene. All good here. Thank you.
Good stuff. Thank you. Thank you all for joining us this morning, and grateful for your time. Looking forward to your presentations this morning. Definitely a lot of moving parts globally, bit of an understatement that, and I'm sure there's going to be some interesting questions from the audience, which we will cover after both presentations. Rory, if you are ready, you can start to share. And as soon as you're done, Andreas, you can present as well. Thank you, Rory. Screen coming through, full screen, perfectly fine. Thank you.
Okay, great. That's a fairly uneventful start, which it makes a welcome change. Thank you, Eugene, and to the BCI team, and for all those that have dialed in for your interest. I manage the Vunani BCI Global Macro Fund, which is a multi-asset global flexible fund, but with a equity-centric approach and a very high equity component in its composite benchmark, which is 80% benchmark to the MSCI World, the balance to the FTSE 3-month T-bill index, and then there's a small allocation of 5% to STEFI. So this is a rand-denominated global fund. So we pose the question today and hopefully present some compelling evidence to confirm whether Europe offers an attractively valued way to access US and a low-risk way of accessing emerging market revenues. And I think that's particularly topical in an environment where areas of the global investment universe, notably China, have performed so strongly over the short, the past couple of weeks. And for a developed market focused manager, how does one actually get exposure to that? And we think the answer is not always that obvious, but there's a very rich opportunity set within developed markets to access these revenues. So the genesis of that idea was really the most recent publication of Morgan Stanley's Global Exposure Guide, which they release each year. And something which really jumped out at me, not necessarily the balance, but really the quantum of Europe's declining domestic revenue exposure. So those are listed European companies that derive their revenues from Europe itself. The US, as you can see on the left-hand side, and emerging markets on the right-hand side, publicly listed companies in those jurisdictions or regions continue to be particularly domestically dominant. In other words, the overwhelming majority of their revenues are derived from domestic sources. Although through the market capitalizations spectrum, clearly that would differ, particularly for the US. If one thinks of the likes of Apple, which derives almost 50% of its revenues from outside of the US, it's not typical of the balance of US companies. But for Europe, it's really quite striking, and it's probably more pronounced at the large cap European level. And we'll give some, I think, compelling examples later on in the presentation. So Europe does not represent, European listed companies do not necessarily represent a play on Europe. In fact, the majority of European company revenues are now derived from emerging markets and from the US. So within that broad and opportunity set, there's a very rich, well, there's a group of companies that offer very rich and interesting exposures outside of Europe. And as bottom-up fundamental investors, those are always something that's always something that we're paying very close attention to. What are the drivers of underlying of revenues and underlying profits, and where they emanate from is clearly an important part of that. So yes, Europe does offer exposure to the US and to emerging markets. So that becomes even more interesting when one takes account of relative performance, presenting perhaps mispriced opportunities. So we know that the US has done exceedingly well more recently. What struck me when I drew this chart was just how well emerging markets have done up until quite recently in a relative sense. Although you can see that the overwhelming majority of emerging markets outperformance over this sort of 25-year period really came in the lead up to the global financial crisis. And subsequent to that, Europe has lagged. And particularly over the last 5 years, Europe is emerging markets have generated less than a third of the US performance. And this is to the end of August. If I roll this forward to the end of September, that number would have narrowed slightly, but not by anywhere near enough, I think, to undermine the point. And that relative performance has obviously also been a function of the rating of these various indices. So the dark blue line here shows the S&P 500 forward price earnings ratio, now at 23.6, substantially above its long run average. In fact, nearly a 40% premium to its long run average, while Europe and emerging markets trade more or less in line with their own long run averages, but at significant discounts to the US. And there are very clear structural reasons for that. And it really, if I summarize in one chart, it's a function primarily of the dominance of the US in the US market of high return on capital companies, or in this case, high return on equity companies. US market is now very much concentrated in information technology. That's true also of emerging markets, although the nature of some of those companies differs somewhat. And what's interesting here is just highlighted in blue relative to the MSCI World. I show the MSCI regional indices and where the US actually has an overweight position relative to the broad developed market index. And it's only in real estate and in technology, although technology is meaningfully the case. Within Europe, Europe leads in consumer staples, it leads in industrials, high quality global industrials, and also in healthcare. And, think about some of the pharmaceutical companies that are domiciled in Europe, for example. While in emerging markets, consumer discretionary and financials, those would arguably speak to more primary economy activities such as retail and food retail and banking, generally lower ROE type sectors. And contrast that, for example, to the US, where the consumer discretionary index would be dominated by Amazon, for example. And in communication services, where the emerging market index might be dominated by your typical telco or mobile telephony companies, Communication services in the case of the US is dominated by platform companies such as Meta and Netflix or Google. And that brings into question also, how some of these companies are classified, and I think highlights the point, or the need to stress the point, that one needs to consider some of these classifications as well as regional classifications in a more nuanced way than industry index providers may typically present the numbers. The typical example I give, is of the two payment companies, MasterCard and Visa. If one goes back to March last year, MECI reclassified those from information technology into financials. So overnight, they went from being IT companies to financial companies. And if one was very index focused, you would pay attention to that. But if one was more bottom-up, fundamentally driven in your decision-making and portfolio construction, you would seek to understand the drivers and the nature of the business in a far more meaningful and nuanced way. And that's true also of regional classifications. A great example, we detail it later on the presentation, is Unilever. Unilever is an Anglo-Dutch company, was previously dual listed on the London and Amsterdam stock exchanges. They made a decision to collapse their dual listed structure and seek a primary listing in London. And so overnight, if you'd been a European investor benchmarked to a European index, you were a forced seller of Unilever. And if you were a FTSE 100 tracker, you then had to buy more Unilever stock. And that's just no way of, I think, investing other people's money. One needs to be aware that, the economic realities are far more meaningful than what is sometimes arbitrary industry classification. So I make that disclaimer. But there is obviously a lot of nuance behind these numbers. But generally speaking, Europe has exposure to very high ROE sectors. And so does the US, but you have to look below the numbers. But this chart explains, I think, quite adequately some of the structural issues around the re-rating of the US relative to the others. But I think we're at a point of extreme now where the relative opportunity and the relative fundamentals are not necessarily supported by the valuation argument. So, the maximum drawdown over that 25-year period for European companies in gray, emerging markets in light blue, and S&P 500 in dark blue. And one can see that with notable exceptions, the financial crisis, drawdowns in emerging markets, particularly subsequent to the financial crisis, have been more severe. So there's more drawdown risk in emerging markets, other than that initial period where Europe was struggling with a sort of Greek crisis and so forth. Also on measured by volatility, which is not necessarily the best measure of risk, and that's a whole nother presentation. One also needs to consider qualitative aspects of risk, and I would argue that taking account of regulation, accounting quality, sustainability standards, and so forth, that European companies relative to the emerging market opportunity set represents less risk, so both quantitatively and quantitatively. So just to summarize that, Europe has underperformed, so have emerging markets. European companies offer significant revenue exposure to both the US at a substantial valuation discount, with less and meaningful exposure to emerging market revenues with substantially less risk, both qualitative and quantitative. So now let's look at a couple of relative stock-specific opportunities. So I think we're all very familiar with the obesity duopoly that exists between Novo Nordisk and Eli Lilly. Both generate the majority of their revenues from the US, yet Eli Lilly trades at a substantial PE premium, or EV/EBIT premium in this case. That's a balance sheet neutral PE to Eli Lilly. Admittedly, they are at slightly different stages of their drug rollout program and measured 1 or 2 years forward. That Eli Lilly premium unwinds somewhat, but not altogether. And here you have a wonderful way of playing those EU or the US revenues through a Danish company listed on the Copenhagen Stock Exchange, but not really foregoing the revenue opportunity, and you have valuation meaningfully on your side. A sector that's provided very rich pickings for us. We've owned Marriott in the past. We currently own Accor and Intercontinental. Marriott and Hilton in this case are US listed, very familiar names in the global hotel space. Accor, maybe less well known, that's a French hotel company. And Intercontinental is the owner of the Intercontinental brand, but specifically also Holiday Inn. Intercontinental generates the overwhelming majority of its revenues from the US, specifically through the Holiday Inn brand. Accor generates the majority of its revenues from Europe, but a significant portion, as much as I think a third, 38%, from Asia Pacific. So a wonderful way of playing Asian consumption and travel growth. Yet that trades at a 33% discount to its US listed peers. And certainly that's not reflected in relative growth rates. And the other major driver of the returns in the sector has been the shift to asset-light business models. The US companies have been at the forefront of that, enhancing return on invested capital by selling off physical assets, so no longer owning the hotels, either managing them and allowing dedicated real estate owners to own the properties, or franchising it and just earning a royalty on your revenue streams. So the extent to which they've been able to grow their brand-driven royalty revenue streams has also reduced operating leverage. Although for Accor, that remains a little bit of a benefit, given Asia is somewhat behind the rest of the world in emerging from the COVID recovery. And so some of that operating leverage at this point in the cycle is favorable for them. But here you have a European company with significant Asian revenues and emerging market revenues trading at a significant discount to peers. On the left-hand side, I just show the accretion that Accor still will experience from their pipelines. Of all these companies, pipeline's quite important. In other words, how many new rooms can you add to your network? And Accor are unique in the space in that the rooms that they're bringing on, particularly in the luxury segments, are accretive to RevPAR, revenue per available room, where for the others, Hilton particularly, it's more dilutive. So there's another value opportunity with differentiated exposure outside of Europe. And then the final one is maybe a relatively lazy example, but I referred to Unilever earlier. Unilever is a Anglo-Dutch company listed in London, but it provides first-in-class exposure to emerging market consumption growth. 58% of its 2023 revenues derive from the emerging market consumer. Here you see also on the right-hand side on a forward PE basis compared to Procter & Gamble, which trades at about 25 times forward earnings. Unilever at a little over 19 times, in line with the MSCI World Consumer Staple Index. So Unilever trades on par with its peers, Procter & Gamble at a significant premium. Key difference might be, or an explanatory factor for that might be that, Nelson Peltz, a well-known activist investor, has been active in both these stocks. He built a position in Procter & Gamble some time ago, sort of shook the tree, for and demanded focus on operating margin improvements and so forth. And that Procter & Gamble management obliged, and delivery on that has been quite exemplary. So the two businesses are not necessarily directly comparable, but he has now also recognized the same opportunity with Unilever, and we expect that management will respond accordingly, and the guidance that he will provide on the board will result in a similar, if not the same, margin performance. So and that PE premium will narrow somewhat. But if you're a believer in emerging market consumption growth, Unilever certainly represents the best way within the developed markets consumer staple universe of playing that theme. And of course, it comes with a significant amount of diversification. So to conclude, the answer to the question, I think in our opinion, absolutely yes, Europe provides a low value and a low risk way of playing US and emerging market revenues. The majority of European companies' revenues now come from those two areas, and Europe represents the minority. The Stock 600, the broadest sort of index of European companies, trades at a 35% or slightly more discount to S&P 500, comes with less volatility and lower drawdown risk than emerging markets, not to mention all the qualitative factors I mentioned. And, being as broad and diverse as it is, offers a major source of idiosyncratic opportunities from which ourselves as bottom-up stock pickers can benefit and gain exposure to global revenue streams. All of that is accessible through the BCI Vunani Global Macro Fund. We manage the equity component, which makes up 80% of the fund at benchmark, in line with our global equity UCITS fund domiciled in Ireland. Those two portfolios are identical. This portfolio has generated top quartile performance over the 4+ years since it's been listed independently. The GIPS composite, of which it makes up a part, goes back more than 11 years. And Eugene, I think I should probably end it there.
Rory, thank you very much. Great presentation. If you can maybe stay on the line, we're going to take some questions afterwards. Andreas, we are ready for you if you are ready. Got your presentation. You're all set to go. Thank you.
Good. Eugene, thank you again for the intro earlier. It's really great to be back here today and to be a part of the BCI family. Before we get into today's story, let me just provide you with some context and some background on the Mazi Global Equity offering. As things stand today, we have about 1.5 billion under management. We have a substantial portion of our own net worth and family money in the fund. We've got a lot of skin in the game. In terms of the Mazi BCI Global Equity Feeder Fund, we've got a 3-year track record now, and at the end of December, we'll hit the 4-year mark. Our underlying dollar UCITS fund in Ireland will have a 1-year track record at the end of November. We follow a proven, repeatable quality investment process that most of you will know if you've listened to us previously. I've managed global equity for more than 50 years now, and I have a team of 6 investment professionals at Mazi working on global equity, and they do this work from Cape Town and Joburg. Today, I'm going to tell you how we at Mazi manage global equity from South Africa. We're going to talk about the importance of a clear quality investment process and philosophy, and the value and use of data analytics to us in our repeatable investment process. And then also we're going to talk about the importance of global travel. A compass and a map are always a good starting point for any job, for any journey at least. The compass keeps you going north, traveling in the right direction, and the map helps you to navigate the terrain. Think of our investment philosophy as a compass to global and map to global markets and the global investment universe. It shows us where to go and what to avoid. So what are we looking for when we look for a global quality company? First off, we want decent, honest, experienced management that is long-term in their thinking and have demonstrated a track record of rational capital allocation. That means that the dollar invested today in the business will give back more than $1 in profit tomorrow. Next, our operators must drive the wedge of innovation and competitiveness. Year after year, our businesses must get better and more durable. These are moats, as Warren Buffett calls them, barriers to entry, technology, IP, brands, networks, customer bases, and so forth. But being profitable is not good enough for us. Our businesses also have to grow. And markets, as you well know, reward profitable growth over time. So if the story with a company is great, we also expect to see it in the numbers. It has to show up. You can fool some of the people some of the time, but not all of the people all of the time. Our businesses must demonstrate sustained margins that are really, really wide, generate lots of free cash, and result in high returns on invested capital. But we're shareholders, so we own things on a per-share basis. So it has to show up in the per-share numbers. So that practically means that our companies must motor not just in terms of per-share earnings growth, but also in per-share cash flow generation. And lastly, we've got to be patient. Good things happen to patient investors. I've now told you and shared some of the high-level attributes that we look for in a quality company, but what does that actually look like in the real world? Here's a picture from our data analytics of Meta. The red line is the cost of capital for Meta over time. In other words, of the capital invested in the business, what do investors expect to return on? Today, you can see Meta has a cost of capital of about 10%, so that's on the right. The green line is the actual return that Meta earns on this invested capital. In other words, how much do they really generate for the shareholders? And that number you can see is about 26% on the right. The gray bars, that represents the difference. It's the EVA, or the economic value add. The bigger that gap, the better. That means the business is intrinsically more profitable. So bigger is better for us. And the purple line is really interesting because that's the cumulative progression of these excess profits that this company generates over time. We call it the financial DNA, or the fingerprint of Meta. Now, whatever haters have said in the past about Meta, we could not disagree with more. Whatever the noise, this picture shows the true quality of Meta. Now, we're a team of about 7 investment professionals, so our team size is not that different from other well-regarded quality managers. But how do we then find the best quality companies in the world? And for that, you need a solid process and great data analytics to identify those companies, and only those companies that meet the criteria of your clear investment philosophy and process. The global equity universe is truly huge. There are about 97,500 instruments listed out there that represent probably about $125 trillion of market cap. We track 90% of global market cap daily. The benchmark, the equi, it's about slightly less than 3,000 stocks. And within all of this, we've found about 120 companies that potentially make the cut of our quality investment criteria. It is this list that we do very, very deep and extensive fundamental research on. And from here, we build a long-term portfolio of about 40 stocks. This screenshot also comes from our data analytics engine. Every single day, we evaluate 90% of global market cap. We are able to identify and shortlist companies that potentially meet our quality criteria. As you can see, some of our existing holdings are highlighted in yellow: ProMedicus, Qualis, Paycom, Arista, Deckers. They remain today some of the most attractive investment ideas in the world right now. The columns on the left in purple and red deal with return on invested capital, intrinsic profitability, growth, and the acceleration of profitable growth. We track all of these things. To the right of this chart, or the table, we score every single company in our universe on the basis of various factors to evaluate the relative attractiveness of this business in the context of all other companies in the world. In very crude terms, we express a valuation view both over the short term and the long term in terms of everything that is out there. This is why it is possible to buy a high PE stock and still get a multi-bagger return, but also avoid a low PE stock, which turns out to be a value trap. The key takeaway from this slide is that machine learning is used to identify, test, and evaluate those factors that are predictive of long-term investment returns in a statistically significant and economically sensible way. What matters for us is what the stock does for investors and nothing else. And that is the key here. In our view, data analytics greatly assists us in idea filtering, fundamental analysis, and risk management. Right. This may be a bit of a delicate matter to some, but the point is well made. You can never underestimate the importance of travel and on-the-ground experience. You never know what you may find. Back in 2016, when Steinhoff announced the deal to buy Mattress Firm for $3.8 billion, that was about 50 billion rand at the time, so still a lot of money today. We own Steinhoff in some of our global portfolios. I sent one of my colleagues to the US to take a look at Mattress Firm. He came back shocked by what he had seen. It was a Mattress Firm store was like an old Ellerines or Bears store, but much worse and only selling mattresses. I remember sitting in an investment meeting saying to my colleagues, when you sell mattresses, you make this much money on each mattress. Do you have any idea how many mattresses you have to sell to pay back the price? The deal doesn't make any sense. We sold Steinhoff immediately, thankfully. But we are trying very hard in our daily work to avoid the next Steinhoff. And that is why we apply data analytics to a very clear investment philosophy and process. Look at this picture on Steinhoff and compare to the picture that I showed you previously on Meta. Of all the things you could have owned in the world, a quality investor would never have gone there. They would have never owned Steinhoff in the first place. You did not need to believe that management was dynamic or that Steinhoff would one day be bigger than IKEA. The truth be told, Steinhoff never cut the mustard. The business was never intrinsically profitable. For the most part, return on invested capital never really exceeded the cost of capital. Steinhoff was a serial capital destroyer at a great cost to many. Enough said. Travel is critical in what we do. We've spent a lot of time on the road since September 22. When international travel opened up after COVID. In just 2 years, we've done about a dozen trips. We've been 4 times to the US, a couple of times to Europe and the UK. And the last year alone, we visited China on 3 different occasions, meeting with companies in Tier 1 and Tier 2 cities. If you haven't been to China, do yourself a favor and go. You'll come back with a very different perspective. The media in the West misreports about 90% of what you read, in my opinion. We have one direct holding in China, but gain lots of exposure through quite a number of our global companies that sell their products and services very profitably and successfully there. China remains a hugely interesting and significant place and an important long-term opportunity set. I've just returned from the US where I met with quite a few of our portfolio companies. We interacted there with about 40 different businesses, and all of our interactions were aimed at improving our investment process over time. Data analytics and machine learning are also hugely important areas for us. We are constantly upgrading and improving our proprietary tools as they form the basis for idea filtering, fundamental analysis, and risk management. Last year on the travel front, in November, our luxury goods analyst is heading off to Europe. We hold Hermès and LVMH and intend to deepen our understanding of this very important sector. Let's finish off with one last story. We own Zoetis. In 2013, this company was spun out of Pfizer. So these are the guys that make Viagra. We met them again in September in New Jersey. Now, Zoetis does animal healthcare pharma. And at its core, it's a research and science-led company. Today, the company is about $8.5 billion of annual revenue. 2/3 of this is in companion pets. So that's cats and dogs. And the rest is then in livestock. So cattle, sheep, swine, fish farming. The share price hasn't really gone anywhere in the last 3 or 4 years, but the underlying business has continued to tick over very, very nicely in the way that matters to us. Following our meeting, though, in New Jersey, we came back much more positive and excited about this business. Things are really changing quickly. For some time now, Zoetis has been working on osteoarthritic pain medication for dogs. Their drug, Librela, is a biologic. So that is a protein compound made in a laboratory rather than a chemically synthesized compound. Librela has now been approved and sold in the EU for more than 3 years with great results, and was recently approved in the US. Zoetis is without a doubt the leader in animal biologics. What makes this Librela drug so amazing is how effective it is. It has become the new standard of care. Now, in the US, there are about 80 million dogs. Basically, 1 in 4 people have a dog, so a dog in every household. 30 million have osteoarthritic pain. It's chronic, so it doesn't go away. It's a lifelong issue for the owners and for Pookie. Currently, 9 million dogs are being treated, and most of these are being treated with steroids or cortisone, and these come with plenty of side effects: skin infections, other types of infections, liver issues, bone degeneration. There's a long list of things. Of the 21 million dogs that haven't been treated for osteoarthritic pain, they either haven't been diagnosed or they can't be treated because the side effects of the existing treatments are just too severe. Librela comes with none of these issues and complications, and the vets love it. So in the 2 quarters since approval in the US, more than 1 million dogs have been put on this biologic. Now, by our back of the napkin calculation, it looks like Librela can easily add another 4.5 billion in revenue to the existing 8.5 billion on the books. This revenue comes at a gross margin of 70% and no real capex. This is the kind of growth and revenue that we like. So let's watch this space. Let's finish off. Like our respected global peers, we get out there and do the work. We have access to the same data, but it's what we do with that data that matters. We are exposed to the same risks and opportunities, but it's how we manage those risks, and our team sizes are similar. And we come with the right experience, temperament, and mindset to win. But the key thing is we are committed, passionate South Africans doing the work from here. And like the Springboks, we also outperform on the world stage. Thank you again for your time and interest. Eugene, thank you.
Andreas, thank you very much for that very clear presentation indeed in terms of how you manage the fund. I want to steer the conversation a little bit to all these things in the media that is top of mind for so many investors. And Andreas, if I can maybe start with you, you made mention in our exposure to China. China is the buzz at the moment. After that stimulus package last week that was announced, the shares just went through the roof. And yes, I do understand, how you manage risk and get access to companies that will benefit from the recovery in China. But if you look at China specifically, and let's focus on the mainland China shares, the A shares, trading at a massive discount. Andreas, would you ever look at picking up more exposure to mainland China, given where they are at the moment?
Eugene, it's a very good question and very topical. I'll just make 1 or 2 cursory remarks before I answer the question directly.
Yes.
I think any deep value investor that's positioned in China, it's just been wonderful. It really is. So that's the first point I'd make. The second point I'd make is that historically, the A shares have not been accessible to foreigners. So due to capital controls, only about 4% of A shares are indeed owned. Now you've got this Hong Kong Connect and that, but it's not really sort of a big highway into China. So you either got to go through Hong Kong and get H shares or indirect exposure. And as the Chinese capital markets continue to mature, so we are absolutely convinced that they will liberalize and open up. And so that will allow far more internal participation. And the third comment that I'd make is that the majority of businesses listed in China are still very capital intensive, low margin type businesses. So they don't really fit with our philosophy and our process in terms of what we look. But as this economy transitions to a consumer-led and a service-led economy, you're going to see far more businesses that really sort of start coming into our sweet spot and that we'd really like to participate in. And that's why we're traveling frequently to China, keeping a very, very good finger on the pulse there, and really hopeful that the place opens up even more because it's a fantastic long-term opportunity set.
Rory, let's continue with the conversation on China and exactly in your presentation, getting exposure to emerging markets, places like China, but via the European market. The bell on China has been rung so many times since they opened in, well, the end of 2022, beginning 2023. We've seen some investors allocating to emerging markets, China-specific funds, burnt our fingers, lots of volatility. But now that FOMO really sets in, your views on China specifically, and emerging market exposure in your fund, will it always be through companies that gains profits as that economy recovers, or would you ever look at direct allocation?
Yeah, so our primary benchmark is MSCI World, so we have a very clear developed market focus. Our mandate, however, does afford us the ability to invest up to 15% off benchmark in emerging markets, and we have one or two examples of that in the portfolio right now. Taiwan Semiconductor, for example, emerging market, Taiwanese listed company which we own, and that 15% limit, incidentally, would more or less equate to the emerging market weighting in the all country world index, which includes both developed and emerging, at what I would regard as a sort of a normalized emerging market weight. It's slightly less than that today, I think closer to 12. So we did that quite purposefully to give us the flexibility to be able to invest in emerging markets as and when we see the opportunity, as bottom-up stock pickers, as opposed to allocating top-down, regionally or by sector. So that's the first point. The second point is that I think the theme of my presentation is quite clear. There, some of these allocations can be quite arbitrary, and so we would look at it in a far more nuanced way. I think Andreas made mention of it also. We've seen a recovery in the likes of Estee Lauder and LVMH, which we own in the portfolio, because of their significant revenue footprints in China. That exposure has also resulted in underperformance over the last 12 months, and Estee Lauder is probably at the forefront of that. We owned it, sold it on the back of repeated profit warnings, largely because of concerns about the unbalanced nature of its business model. It was overexposed to China and arguably over-earning in the high margin sort of luxury skincare business, Le Mer in particular, which has a very strong presence in the Chinese market. So one has to be, I think, aware of those sorts of dynamics. But China, maybe just taking a step back and looking where we are, yes, there have been a few false dawns. And time will tell whether the stimulus applied results in a sugar high, what we're experiencing right now. But from my perspective, what is required is far deeper structural reform, I think, to make changes sustainable. And I think we'd like to see more of that.
Like the way you put it, a sugar high, it could potentially just be that. Rory, a question from the audience, speaking to European stocks. How much of the underperformance in European stocks is a result of the war in the Ukraine, and does the earnings of these companies justify the possible risk of a further escalation in the region?
Sure, that's a tough one. I mean, the honest answer is we don't know the exact extent of that. And the war in Ukraine, I think, the impact has been felt more broadly than just Europe. If one thinks about the stocks that would be immediately impacted, for example, the energy space, you'd think, and you can draw parallels with what's happening in Israel right now as well, and what's been going on. Energy prices up until very, very recently, as in yesterday or the day before, have actually been quite muted, and in fact, on a year-on-year basis, are actually down. Generally, in times of unrest and war and volatility, oil and energy prices generally on the up. Where we would see the benefit, for example, in our portfolio is we have exposure to two defense contractors, Raytheon and L3 Harris. And those have clearly benefited, I think, from ongoing trouble in Ukraine. And I just noticed last night, unsurprisingly, both of those rallied quite sharply. They differ quite meaningfully in their exposure. L3 Harris, which is probably less well known, we like because of its differentiated exposure to the space program, which is the highest or the fastest growing component of the defense budget. So that makes it slightly unique. But European underperformance directly attributable to Ukraine, I'm not sure you could draw a straight line between those two.
Corey, thank you. Andrea, sticking to macro, and again, I mean, if you watched the events the past 2 days, and one of the reports last night is breaking news on breaking news on breaking news, the attacks on Israel. I mean, could an escalation in the Middle East impact on any of the companies you have or hold? I mean, you've shown very clearly you focus on high quality companies that's got good potential in growth and earnings. So the question rather is, does it really matter? Because the companies that you look at surely benefit from, or could potentially still show sharp growth in earnings, and it's more about the macro and monetary cycle as opposed to, geopolitical events.
Yeah, Eugene, I think it's a good question. You almost touched on it in the intro. There's been a lot of macro going on, and when I say and war, uncertainty about US elections, and then sort of a soft landing, no soft landing, and recessions, and then the ebullience about China suddenly. And so there's been a lot of macro. Directly, it does not affect in any material way our underlying companies, but certainly in markets, how markets price risk, and they go risk on, risk off. It's going to have an impact, and you may have a temporary underperformance. And what is very true, which we saw now in the last quarter, is when there are jitters in markets and people get margin calls, they have to sell their best investments because those are the most liquid. So you've had this funny situations. Some amazing stocks fall for no real fundamental reason. That's because these are stocks that are providing liquidity to plug holes in portfolios that are not so solid. On the war in the Middle East specifically, I'd make one comment and just reference when Russia invaded the Ukraine. We had quite a lot of questions from investors. She's like, guys, what's going on? What's the impact on your portfolio? And we were able to, with our data analytics, show very, very clearly that we earned less than 1% of revenue through all of our portfolio companies in Russia and Ukraine and Belarus, which was sort of the three territories. And I'd say, what's happening now we did this analysis again with Israel and in the Middle East again, it's negligible in our lives. So in terms of our investors having comfort in the types of businesses that we own, we're okay. But that does not mean that, share prices cannot be depressed for some time, and that we all, have to take a little bit of medicine.
And I think that's a very important message to investors as well, is taking that comfort in the abilities in looking at stocks that can still continue to grow earnings, regardless of what's happening in the world out there. Andrea's question from the audience, more stock specific, on Zoetis. Are there any concerns regarding the class action lawsuit on Zoetis in May, June? Does this factor into your decision-making process, and will it remain a stable source of income or revenue in your fund?
So it's a good question. We actually addressed the topic with management, and to the best of my recollection, Zoetis hasn't made any kind of provision for the lawsuit. The lawsuit that is referred to the question is specifically about Librela, and that there are side effects and complications. And now they want to sue, and the firm, this Shell, I think that's the Shell firm. They're known for sort of spurious litigation, but let's just see the thing through. The long and the short of it is that Librela has now been used very effectively for 3 years already in the EU with no major issues. Every single drug is going to have a number of complications and issues, and people are going to litigate around that, and that is the nature of the business. But where the company stands today, the data set that they have that eventually will show up in any kind of court case, that the merits of the matter will be discussed and evaluated on, certainly point to Zoetis being, not, I don't think, being adversely affected by this. So we remain okay with our position. But, the other thing is also to say, we talk, and Rory spoke about 3 different investment cases. And so we talk about granular detail about investment cases. But remember, we own portfolios, and it's specifically to deal with the risk that we might not be right on something and might not be able to fully, catch everything or understand everything about the stocks that we have great conviction on. So it's important just to remember, you've got safety and comfort in the breadth of our portfolio. We think it's unlikely that the lawsuit, proceeds, and we think it is without merit, but time will tell.
Very interesting indeed. And I mean, if I do look at both the funds and both portfolios, you've definitely proven that you can stand the test of time regardless of market cycles and get it right more often than not, outperforming the peer group handsomely. Rory and Andreas is unfortunately all we have time for this morning. I really want to thank you for coming on. It's been a great pleasure to have you. And insightful presentations and conversation indeed. There's a couple of more open questions. We'll circulate that and get that back to you as well. For the audience, both funds, the Vunani BCI Global Macro Fund and the Mazi BCI Global Equity Feeder Fund, available on most of the big platforms. If you want more information, you know how it works, give us a shout and we'll get you in touch with either Rory or Andreas if you want more information on their funds. Gentlemen, thank you very much. To our audience, thank you so much. Quick reminder, next week, Wednesday, 9 October, we're continuing our conversations with Investec and Cadis Asset Management. Andreas, Rory, thank you. We'll chat to you soon again.